Most of the big platforms, Euler Finance, Fluid, Morpho, yield aggregators like Harvest and stuff like that are using the ERC 4626 standard, which makes auditing these contracts much, much easier. It's much easier to see, where the flow is going when you deposit funds, where they end up, and that sort of thing. So in that sense, things have gotten a lot better. I think the real risk is mostly on the implementation side of things now, right? Because we're confident in these standards, that they're robust and reliable, and they're battle tested. But at the end of the day, it's still a team that's managing the funds that are deposited in these vaults, right? So think about all of the curators, RE7, Gauntlets, so on and so forth. The vaults are only going to be as robust as those strategies. As a trader, you have to take into account when you're, looking at those APYs, wow, 70, 80% APYs on a stable coin, that's crazy. But, you have to dig a little deeper than that.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features one of the top smart contract engineers in the world, the original co-founder of Zapper, and now founder of Portals.fi, Suhail. So this is an episode where we have a very candid conversation with someone who is an engineer that really understands all the different DeFi protocols and how they're architected. But he also is a longtime DeFi power user. And the goal of this talk is for us to understand, where does Suhail see risk in the different types of protocols that are flourishing? We talk about, what are some of the risks that maybe we're overlooking now that DeFi is, becoming more mainstream? And I think our goal is to walk away with a better understanding of how to approach finding the best DeFi yields on chain, but how to also get into and out of those opportunities without blowing ourselves up.
Yeah, and it was interesting to get his perspective with his technical background as a builder, because, both you and I, we have our own approaches that we've sort of fostered over the years. And I now don't even think about these things as much, when I'm navigating, but in the background, you're okay, what's the TVL? What's the team? Was there audits? Is there a transparency dashboard? Do I know where funds are that I'm, where they're being held, that I'm deploying my funds into? All these types of things. But then in talking to Suhail, he comes at it from that plus a totally different angle, because he builds this stuff. So he knows where to look, and he almost has a different starting point of where he likes to begin with. So I thought that was really interesting to get his perspective on how he navigates DeFi.
When I enter into a yield, let's say a Pendle PT position, I do often look at what am I entering with? Is it possible that I might be able to get more PT tokens depending on what token I'm using? But on the front end of something like Pendle, they try to make it as easy as possible, and you can choose whatever asset you're going to use to enter with. The difference with something like Portals is they're doing all of that work for you. They're looking to make sure you get the best rate getting into these opportunities, maximize the exposure that you have, avoid mishaps with things like MEV. So, the conversation is less about Portals. I really do believe we probably talk about Portals, maybe 5 to 10 minutes near the end. But I think the need for something like Portals is more apparent when you start to talk through all of the challenges that still exist. I mean, frankly, I thought that getting into DeFi yields was less of a challenge now that things have changed and there's such a better UX and there's better apps and better wallets. But I think as we talk through the conversation, you do get a sense that there's still lots of challenges. There's lots of mishaps that can come up. There's a lot of opportunities that require multiple steps in order to get into those yields. And, the goal here is to abstract away some of that, as a user, just be able to get in and out and track your portfolio and maybe even discover new opportunities by using a tool like Portals.
Yeah, and not only do we go through risks and try to identify, potential contagions or blow up risk within DeFi, but we also take the opportunity to ask Suhail about what is he excited about in DeFi, What are the trends that he thinks are real, have staying power? What's he deploying into? So we go over all of that in this show as well.
So before we get started, just a reminder that you can subscribe at the-edge.xyz. That's the best place to get, instant notifications when we release a podcast. If you check out our link tree at edge_pod, you can subscribe on Apple or Spotify or YouTube. Those are other popular places to enjoy the podcast. And then just a final reminder, thanks to our sponsors that support us here on the Edge podcast and Edge newsletter. Please check out the show notes, or you can find them in any of our newsletter articles. Be sure to learn more about those folks. They're all doing important work, and we spend a lot of time trying to curate the best sponsors, the sponsors that represent protocols that we think are doing really interesting work in DeFi. REDSTONE is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, REDSTONE delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose REDSTONE oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need REDSTONE's leading modular blockchain oracle layer. To learn more, go to REDSTONE.finance, and thanks to REDSTONE for supporting us here at the Edge podcast and Edge newsletter. Maple Finance is one of my favorite products in DeFi. It is a gateway to sustainable real yield, powered by over $1 billion in AUM across USDC and BTC products. And now with SYRUPUSDC by Maple, anyone can earn institutional-grade yield. Learn more at SYRUP.fi, and thanks to Maple for supporting us here at the Edge podcast and Edge newsletter. FALCON Finance, the team behind the fastest-growing synthetic dollar, with institutional yields that are competitive and sustainable, offering yield optimized across your favorite DeFi protocols. Point season is now live. Learn more at falcon.finance. All right, let's introduce Suhail, the founder of Portals.fi. Suhail, welcome to the Edge podcast. How are you doing?
Thank you very much. Doing great. Happy to be here.
There's a little bit of background here. I've known Suhail for years. We've been friends since, I think, 2020, 2021. I was just getting into DeFi. I was, playing with protocols, and Suhail, being a co-founder of Zapper, was, part of the team that hired me. So I worked for Suhail and the team for a bit of time there at Zapper, and I think he's one of the top 10 smart contract engineers in the world. And so what's prompting our conversation today is, one, I think more people should know about Portals.fi. I think that Portals.fi is delivering the original vision of Zapper that drew me in, which is giving you one-click DeFi into every imaginable sort of opportunity. But two, I think that he is one of the very few experts in the world to comment on the state of DeFi yields, to tell us what looks safer, what looks riskier, what should we be worried about, what keeps us up at night. And so, we're going to talk all about that today. So Suhail, why don't you tell folks more about your background in DeFi, in crypto? Tell us about all the cool things that you've worked on over the years.
Yeah, thanks. I've been in DeFi since the early days, back when Aave was still called ETHLend, and DeFi was basically just ETHLend, Compound, and MakerDAO. And my intro to DeFi was through MakerDAO, which is interesting because their contracts are very convoluted. They have very interesting names like Guy for holder and Tub for other things. So it was a bad intro for me because I'm trying to figure out MakerDAO's, nomenclature, which was uncommon and still is uncommon. And it was a fun ride. And back then in the early days, we had the InstaDApp guys building, in the same space. We had the Balancer founder also building in the MakerDAO space. So all of us were pretty psyched, early on. And I wasn't a smart contract dev back then. I was, not even really a dev. So it was my intro into programming. And that's how I learned. I was 28, 29 when I started learning how to program. and it was through DeFi and crypto. So it was a really exciting and defining period in my life, because I didn't get into traditional finance. So all of my financial literacy comes through crypto, and learning the ways of the degen early. So anyways, I ended up taking a smart contract class through Consensus, because they had an excellent boot camp back in the day. And that's where I met one of my co-founders for a company called DeFi'S app. And DeFi'S app would eventually become Zapper. So we created first the Zaps, which are these one-click interactions to get you into and out of these complex DeFi positions. Back in the day, that was Uniswap V1 and Synthetics. You could liquidity farm with, I believe it's called Seth. And that was DeFi. So we built these cool interactions around that called Zaps. And these, it turns out, are timeless, because, lots of companies are now incorporating Zaps in their flows. Of course, they make things easier for traders. They increase TVL for protocols, because, of course, there's less friction. Everything becomes one-click interactions. So that's been my ethos, is to make DeFi easy, accessible, as close to one click as possible. We kind of want to make DeFi like the buy it now button on Amazon. You click the button, it shows up at your door the next day. You don't care about the route it takes, the capacity of the truck, how much the driver is being paid, that sort of thing. With DeFi today, you very much are concerned about those things. What's the capacity of the truck? How much is the driver being paid, right? What route am I taking? That stuff should all be abstracted away, and that's kind of what we're trying to build out here.
Years ago, if you wanted to get into a Uniswap LP, you needed to prep both of the tokens that would go into that. You had to have the exact specific amounts, depending on whatever the tokens were, whatever that ratio was between the tokens. This is a really clear example of like the complexity that you might have faced as a user. But, now anything you enter, like a vault, or whether you're entering into like a Pendle PT position, I noticed like you're able to basically do it with any imaginable token. It seems like all the front ends are adopting, like, how can we provide the most like frictionless path to getting into this? And like, I'm wondering, like, what do you see from the developer side? Like, is this because they're using an API like Portals? Like, what's happening to, I guess, improve the ability for us to get into any imaginable DeFi position?
Yeah, so I mean, composability has obviously increased dramatically since the early days of DeFi. Most DeFi positions these days are now composed positions. So things have become more difficult to get into, not easier, right? So we think about Uniswap V1, V2. You had to have the correct ratio of assets. Now with concentrated liquidity pools, Uniswap V3, V4, airdrome, slipstream, those sorts of protocols. Not only is it more difficult to get into those positions, it's also much more difficult now to manage those positions, because you have to be an active manager as well. So these are kind of some of the intricacies that are making DeFi more complex and more difficult to use, despite the actual positions themselves being generally higher yielding, right? Because they're composed of multiple assets. So you may have a vault whose underlying token is a pool, who's, you're earning trading fees on those, of course, in addition to the vault APY. And then the underlying tokens of those pools are probably going to be, interest-bearing tokens, right? Maybe an Aave token or something like that. So that's even more interest you're now earning. So think about how you get into that position, right? And all of the steps involved. So let's say you want to get into that Aave position. So you first figure out, okay, what do I want to swap for, let's say, Aave USDC. You go to the Aave app, you have to do an approval. You get your Aave USDC token. Okay, now you go over to the Curve app. Okay, now I got to figure out which pool I want to enter in, because I need to get the right one for the vault. More approvals, of course, right? And then you enter that pool. Then you go on to another app, right? A vault, maybe Harvest, Yearn Finance, BFI, something like that. Now you have to do another approval and deposit that asset into that vault. And then sometimes those vaults can also be staked, right? So that's, what is that? 10 transactions, 11 transactions to get into a single, yield opportunity. Think about all the steps that can go wrong, all the gas you're paying, inadequate swaps. Maybe you're not getting the best deal you could. Maybe there's some MEV involved. All of these sorts of things make DeFi more complex, more difficult for traders. And oftentimes they're just going to be like, you know what, I'm just going to leave it in Aave. I'm happy with that 4%. Even though, if you're a real degen, you go on Contango, you're at 70% sometimes for stables and stuff like that. That's the real power of composability. It's a huge force multiplier.
One thing I remember, Suhail, like working with you is that as new DeFi apps were launching, just because we're all like talking in whatever it was, Slack or Telegram, and, we're going back and forth about like, this looks like a legit new application. There's TVL building. But what you were able to do was actually look at the smart contract level and start to examine and investigate. Does this look safe? Is this the sushi farming type contracts, the sushi chef contracts, if I'm saying that correctly? Or is this like totally new contracts and needs more investigating? So I'm like wondering what nowadays looks risky to you, like at the smart contract level, like what in DeFi is maybe potentially becoming more popular, but has you slightly concerned for the risks that are involved?
One thing real quick, I would even caveat, not even at the smart contract level, but like what looks like it has blow up risk as well, like just maybe mechanism design or too much composability and not enough risk management just in the process.
Yeah, in terms of security, vulnerabilities, that sort of thing on both on the smart contract side and also on the implementation side of things. Of course, back in the early days, we had vaults as we do now. Andre, created one of the first vaults through Yearn Finance Wi-Fi, and since that time, people have realized this is an awesome standard. We need to standardize this. So, what some smart folks did is they created a new an ERC called ERC 4626. It's called the Vault Standard. This reduces a ton of risk because every single vault is standardized and it has certain methods and patterns that you must follow, right? So most of the big platforms, Euler Finance, Fluid, Morpho, yield aggregators like Harvest and stuff like that are using the ERC 4626 standard, which makes auditing these contracts much, much easier. It's much easier to see, where the flow is going when you deposit funds, where they end up, and that sort of thing. So in that sense, things have gotten a lot better. And if you're a smart contract guy, it's easy to audit those and see what's happening with those funds. I think the real risk is mostly on the implementation side of things now, right? Because we're confident in these standards that they're robust and reliable, and they're battle tested. But at the end of the day, it's still a team that's managing the funds that are deposited in these vaults, right? So think about all of the curators, RE7, Gauntlet, so on and so forth. The vaults are only going to be as robust as those strategies. So if they decide, we want to earn a competitive rate versus our competition, we're going to, ape into a slightly more degen stablecoin vault or position. And the real concern there then is contagion, right? Because often these vaults are deployed in multiple different assets, right? So you'll have some in Morpho, some in Aave, some in Compound, whatever else. And then maybe they'll take 12% and throw it into a slightly more degen opportunity. And the risk there is the contagion, right? Because it boils down to how well the team that made the stablecoin is, right? How good they are. What are their stability mechanisms? How are they maintaining the peg? What's their track record? That sort of thing. And we've seen a huge explosion of stablecoins. Stablecoins are, the thing in DeFi, right? It's what we know for sure as product market fit. It's where everyone wants to earn yield on. And we've made it really easy for them to earn yield on those. Just deposit USDC into a vault and we'll take care of the rest. The tricky part is we'll take care of the rest part. That's the hard part to audit, because there's no, you can't look at the contract and realize, oh, they're depositing it in Morpho or whatever. You have to look at the actual transaction flow, where these strategists are putting the funds. That's the part that, kind of keeps me up at night, because at the end of the day, as a degen, as a trader, you can execute these strategies yourself, deposit, assets in the same place as these, multi-million-dollar, curators are depositing them. They're degens, they're on chain all the time, but, there's tools like DeFi Lab, Portals, DBank, Zapper, all of these tools that you have access to make the same decisions that they do and curate your own risk profile. And, one thing we've been getting a lot of requests for at Portals is we want to see the risk profiles of these positions, right? So if I'm in a stablecoin pool with USDC and a brand new stablecoin, that's potentially pretty risky because there's a depeg risk there, right? What's the impermanent loss risk, right? These two assets may not be correlated. Even if they are correlated, we've seen depegs in the past, right? With Stack and ETH, right? The ratio has dropped below what it should be. So these are all things that, as a trader, you have to take into account when you're, looking at those APYs, wow, 70, 80% APYs on a stable coin, that's crazy. But, you have to dig a little deeper than that.
Yeah, and something like you're calling out is almost like a meme of last cycle that is totally relevant forever, is where does the yield come from, right? So last cycle, it was mostly inflationary yield in the form of incentive. So, teams just funneling their own governance token back into the yield and propping it up with like, okay, it's a high APY, but it's just going down because of obvious reasons. So this cycle, we're seeing way more real yield, but way more experimentation on that quote unquote real yield. And again, where is the yield coming from, to your point? So I think like protocols that have these transparency dashboards, that is like table stakes. You absolutely have to have that. You need to know where some of this like off-chain stuff is being held and custodied, if it's Fireblocks, Copper, just a good kind of map of where all this yield is coming from, where assets are held, which chains they're held on. If you can do that, you give people a ton of confidence. But yeah, is there anything else you think? Is there anything else I'm missing on? Like, what else do you look for when you're trying to break this down yourself, Suhail, or kind of create this, I guess, good feeling for yourself to enter into maybe a newer project or a newer stablecoin with nice yield? Yeah.
So for myself, obviously, I'm going to first look at the implementation on chain, right? And it may not be super in depth, right? Like I'll look at Etherscan and, I'll look at some recent transactions and make sure, the peg looks all right, stuff like that. Looking at the vault contract, is it an ERC 4626 contract? Is it a boring vault implementation? Is it some other custom implementation? That'll give me some pause, right? Because I'm not sure, I'm not going to be able to pick up brand new patterns immediately just by one read, right? It takes time to look at these contracts and understand what they're doing. That's definitely going to give me pause. So I was interacting with a new project yesterday. I won't mention any names. And, I asked them, like, you're launching a new vault protocol. What's the standard? And they told us, oh, it's a brand new one based on 3.3 concept, right? And I was like, oh, interesting. I'll probably not, ape into this one right away. I'll wait for some braver degens and, assess. But then the risk of that is, of course, if it is a legit opportunity, you're leaving money on the table. So what's the opportunity cost of you being so overly risk averse? Ultimately, we're all here to make money, right? The goal of the game is to make a better life for ourselves and our family through DeFi, right? So in doing so, you have to be careful, but also don't be a total wuss and be like, oh, this is ridiculous. Like, I've never heard of this protocol. They're just all marketing. I'm not interested in it. You should spend some time looking at it. Look at what smart folks are saying, especially on Twitter. Look at what DeFi Dad's saying, look at what Nomadic's saying, Steven from DeFi Dojo, these types of guys who are absolute degens, live and breathe in the space. Their opinions are valuable, of course. And of course, they probably, are talking to the teams directly. They have more insights than you might see just on Twitter or on X or on Forecaster or wherever you like to hang out. So yeah, a lot of the research is actually starting for me off-chain, right? So I'm going to see a brand new opportunity pop up. UNIFI, right, is a good one, right? That's been a big one. If possible, we're going to tweet at the team and ask questions. I'm going to look at their app, make sure it's not, some crappy copy that's obviously, AI generated, low effort. You want to look at the flow, the transaction flow when you actually enter the protocol. Are there bugs, when you're about to sign a transaction, like the approval transaction doesn't pop up like it should? Stuff like that are all red flags for me, right? So it's also about quality, the quality of the team. But yeah, not being a wuss also is a big part of it. You're not going to get anywhere if you don't take risks in this space, of course. But at the same time, you don't want to ape 100% into an untested protocol. Do 5%, wait a week, 2 weeks, assess if you're happy with it. Proceed. If not, then look for something else. And just real quick on the curators, that's kind of also a double-edged sword, right? Because they want to show we're in legit opportunities, but as someone like me, I go to those apps and I look at where they're deploying, and I just deploy it myself, and I don't pay the 10% performance fee, right? So that's a huge savings for me as well. They do all the research for me. They do all of the auditing and the vetting, and I just zap in, right? And I'm happy. So.
This episode is brought to you by MANTLE, pioneering a revolutionary new category called blockchain for banking by bridging TradFi and Web3 into one unified stack. With on-chain transactions, TradFi rail compatibility, and integrated DeFi features, MANTLE is reshaping how financial services work. Their flagship app UR lets users hold fiat and crypto all in one Swiss-backed account, making real-world finance usable on-chain. To learn more, go to ur.app and follow mantle_official on Twitter. Spark, one of the leading DeFi protocols, has had a year like no other, deploying $2 billion into RWAs with BlackRock's Biddle and other institutional giants, adding over $1 billion in TVL, and distributing over $9 billion across the DeFi ecosystem. Now, Spark are setting their sights on further global expansion and have introduced the Spark token, which is available on leading centralized exchanges. There's never been a better time to discover Spark, the on-chain capital allocator. Learn more at spark.fi. There's a few different examples here that I want to call out. One, I think that you're hitting on is there are these like liquid fund strategy type vaults. Like you're basically using a vault to deposit money that is then being used by some proclaimed professional investors who are going to earn yield on your behalf. It sounds fantastic. I think to your point, like if you don't think you can run that strategy yourself, or maybe you'd rather have the strategy running, and if the vault itself could act as collateral elsewhere, like that could be a benefit. But I think that is an example that is more risky to me, where you're trusting in someone else to run this strategy, and let's view that vault as just like it's a mechanism for you to deposit money and say, hey, here's my money, go do whatever with it. There's normally delays to be able to withdraw that money as well. So, again, you're taking a risk that probably looks like something in the real world if you're, working with a fund that is running strategies on chain. But I would argue you don't have like the legal backing that you probably do if you went about it in like the real world. The other example here, though, with risk curators, do you have any concerns with like contagion from risk curators getting blown up? Like I'm thinking about the fact that Morpho vaults are always over collateralized. So there's protection there. If you lend money into a vault, you're supposed to be protected by the fact that the borrowers are over collateralized. I think what I'm not fully caught up on, and it has me worried about what I don't understand, is there is a small world of risk curators out there. It looks to me like they're running as many different strategies across as many different vaults as they possibly can. And so I'm worried about the musical chairs that's probably going on with that money. And like, if one of them gets blown up as like a borrower in one of their own vaults, like I'm thinking of someone as a risk curator that is putting up their own collateral and then borrowing because other folks are lending to that vault. And just like, what happens if they get blown up? And like, could there be like some aftermath of this? Technically, if they're all over collateralized and it's pristine collateral, we shouldn't see some mega type blow up. Like this isn't like Terra 2.0, but I do think there could be a panic, and you could definitely see some sort of aftermath of all of that. So anyways, Suhail, like, what are your thoughts there? Like, does this have you concerned at all in terms of the risk curators out there?
Yeah, for sure. And I mean, there's also some other mechanisms, right? Some other mechanisms as well, right? So I'm sure you guys remember Rari Capital, one of the first lending protocols to introduce isolated pairs, basically, right? And that's something that Morpho does, what Fluid does as well. So in addition to over-collateralization, we have isolated pairs, right? So the contagion there then is slightly, it's slightly less, right? Because one Morpho vault goes, it gets screwed over for some reason, some contagion, right? Then the other Morpho vaults are not affected, which is great. However, the contagion, risk is real, right? Because like you said, these risk curators are running tons of strategies. Some of them may be, delta hedging strategies using centralized exchanges and stuff like that. So there's risks of, even exchanges, centralized exchanges going belly up. We've seen that before, of course. But yeah, like we've mentioned previously, stablecoin risk is a big one. There's tons and tons of stablecoins being launched. If you look at the DeFi Llama stablecoin dashboard, I think there's, close to several hundred of them, right? And if they decide that they want to, take a risk on one of those with even a small portion of their assets, if you're in there to make money and you're up 12%, right, in the last couple of months, and they make one bad bet, you lost all that money. In addition, you're also paying them a management fee or performance fee, right? So that's kind of why, I'm a little skeptical about, chucking my assets into these kinds of vaults. But at the end of the day, some of these strategies are more sophisticated than, I can pull off or have the time to pull off, right? Like, look at what Athena is doing, right? With, SUSDE and their complex delta hedging strategies. There's no way I could do that on my own. And vaults that are employing these strategies, yes, there's risks to them, but at the same time, they're doing it to maximize their ROI, right? And attract more TVL so they can get even more ROI. So yes, there's a contagion risk, but these risk curators, it's their bread and butter, right? They do this every single day. They get paid very well to do this. And think about the reputation risks that they would have if they were to screw up just one time, and not just for their company, but all of the platforms they use under the hood, right? Think of the backlash Morpho would have if one of their risk curators screwed up, right? And if you're a retail, trader and you see, oh crap, Morpho vault just got wrecked, I'm just not going to use Morpho, period. Even though, yes, we're over collateralized. Yes, it's an isolated lending pair. Yes, we have, risk curators managing this vault. The blowback happens to other companies, other protocols that are also involved in this space. And then it'll affect other risk curators as well, right? If Gauntlet screws up, RE7 might face some blowback as well because, they're all the same or whatever, right? So, there is definitely the contagion risk there. But at the same time, like I said earlier, you have to, put some risks forward, right, to make money, right? It's going to be really hard to pull yourself out of a hole at 4 or 5% interest on the USDC variable rates, right? So contagion, yes, it exists, but I think it's well managed, and I'm comfortable entering all of these positions and playing around with them for sure.
Let's talk more about then. You say you have to take a risk at some point. Like, let's talk where you're maybe putting some of your money, or maybe even trends in DeFi that you're excited about that you think have staying power. I guess that are real, and where you personally want to focus your attention going forward in DeFi.
So we'll start out where I like to deploy. So I'm a Bitcoin guy. So for me, Bitcoin and DeFi is big. So I'm looking at, folks like Solve, Lombard, those types of platforms. The APY is not so great. It's like 0.26%. But at the end of the day, you're still holding Bitcoin, right? So as long as Sailor keeps pumping my bags, I'm happy. And I'll earn a little bit of yield on top of that as well. But yeah, the thing I've noticed with Bitcoin, especially in DeFi, is there just isn't a ton of liquidity. So especially I like to play with Contango and Pendle and, employ looping strategies. And every single time I go to the Contango page and I look at Bitcoin, there's like almost no liquidity, right? So if you really want to leverage up, really multiply your yield, you have to be really early in those PTs. As soon as those markets open up, you basically have to get in there. But then, you're also exposed to the risk of the PT, right? The PT versus the SY, the underlying. Because if those diverge too much, that affects your yield. Obviously, the higher the PT goes, the worse it is for you to get in early, right? So those are some of the places I like to play around in. Contango has been awesome for that. Euler also has looping strategies you can use. And I found that Contango is a little bit friendlier for me. Like I prefer using it over Euler, at least at the moment. However, I heard that Pendle recently launched PTs on Euler, I believe like yesterday or something like that. So that's an interesting section we can play around with for sure. So I'm a DeFi guy. Obviously, I like to hold, what I like to call the core assets, right? So ETH, Bitcoin, some stables, right? But I'm not really, degenerating into meme coins or even governance tokens and stuff like that. Like I don't have, Uni or Maker or that much Aave or anything like that. It's basically all ETH. Stable coins, Bitcoin, that sort of thing. Having been in the space for so long, I find it really hard to actively trade such that I'll outperform just holding Bitcoin or ETH. Well, not so much ETH these days, but hopefully soon. And we're seeing, folks like, Tom Lee with his new company employing the same strategy as Michael Saylor. So we're starting to see a lot more interest in ETH now as the, the asset of the world computer. It's, settling, more transactions, some days than, major credit card companies. Remittances are huge, right? Stable coins make it easy to send funds back home, for example, or if you're in a country that's, unfortunately been affected by inflation, then, stable coins are a good way for you to, live basically, right? I always think about, Mariano Conti, one of the early OGs of MakerDAO, who was their head of oracles. I believe he lived in Argentina the whole time, and he took his salary in DAI, right? So just an awesome use case of DeFi. Stable coins, really, really making difference in people's lives. Other aspects of DeFi that I'm interested in, I think real world assets are really cool. I've always liked the concept of tokenized real estate. So imagine owning like a huge commercial building. You can own a certain percentage of that, whether that's represented, as NFTs or, ERC20s or whatever. We were working previously with a company called Landex, who does tokenized land ownership, which is a really cool concept as well. All of the wealthiest folks, the billionaires are always buying land, right? Look at what Bill Gates is doing, buying tons and tons of land. As degens, we have an opportunity to participate in this as well. So I really like where real world assets are going. In terms of, the AI boom that we've seen, it's interesting to me because I would not trust AI to order me a pepperoni pizza, right? Like I would be concerned that it would screw up the order. So it's hard for me to understand how anyone would let AI manage their finances, right? Completely autonomously. I don't think we're there yet. So for example, if you tried to get AI to order 10 pepperoni pizzas from 10 different restaurants in a row, what do you think the successful order rate would be of that? It's probably not going to be 100%. And is that a risk you're willing to take with, your finances? No, not for me anyways. So I think they're cool for informational purposes, to learn about DeFi. What does this protocol do? Where does it deploy? How do I get in? But ultimately, I think still, users, traders should be responsible for making those decisions. So I haven't played a ton around with those, but we'll see. They'll improve, right? We have smart people working on these all the time. They're going to get better. The LLMs that underpin them are going to get better. We've already seen from Claude 3.5 to Claude 3.7 to 4.0, huge differences and improvements in those. So it's a matter of time. I don't think we're there yet, but hopefully, teams will keep cracking away at that stuff. But at the end of the day, it's all DeFi, right? And rising tides lift all boats, right? So we just need we need to have, certain sectors of DeFi that are successful, robust, reliable, give retail traders coming in from Robinhood and those sorts of apps a real feeling of belonging. So I think that these AI agents are really good entry points into DeFi, really good ways to explain how DeFi works, where to be, what the popular opportunities are. But still, I would rely on, DeFi Llama, Portals, and those types of apps to ultimately make those decisions and enter it or exit them manually, for now at least. So yeah, those are a couple of the segments that I'm interested in right now.
One of the strategies that like all of us spent a lot of time on was being a liquidity provider. And I do feel like the impermanent loss that burned a lot of us led to many of us avoiding certain strategies there. Like if you're in a correlated LP, if you're in something that's all stable coins, or if you're in something that's like an LRT, LST, and ETH, like it makes sense. But one of the unlocks this cycle has been fluid. So the fact that like we can hold an LP and then borrow against it and borrow at like really high LTVs and have the smart debt types of LPs, like that has been a real innovation this cycle. I guess like is fluid making it more possible for you, or you think anyone else, to return to being an LP? Like what's the advantage there, or what is potentially the disadvantage?
Yeah, so I really like Fluid. First of all, the team is excellent, right? The Instadap guys have been around for a long time. They've had a bunch of excellent products. One of the other ones I really like is Avocado, which is like this RPC kind of wallet that they have. But in terms of Fluid, I think, yeah, you're right. It does make LPing easier, and that's the point, right? It's by design. That's why they've managed to attract so much liquidity in such a short period of time. It's why they're, doing more swap volume than some days. Uniswap V4 pools and some of these big guys. The mechanisms I think that Fluid has, released to the world are going to be copied and replicated many, many times over. The thing with LPing now is it's harder, right? So if you're in a Uniswap V3 position, you need to actively manage that. You're providing a liquidity in a range, right? It's no longer like B2 where it was infinite and, you just set it and forget it and hope for the best. So impermanent loss is magnified with CLPs because of the tick range, right? The narrow range of liquidity you're providing. But it also opens up more advanced strategies as well, right? Because these orders are also basically limit orders. So if you're happy to sell ETH at 4K when it pumps up there, in a couple months, you open up a position, USDC WEF, you put in your range and you say, listen, I'm happy to have all USDC at 4K, and that's fine by me. But you have to be a pretty sophisticated trader to be able to pull that off, to understand the implications, and all of that stuff. So it's hard, right? And that's why we see companies like Arrakis, protocols like Arrakis popping up, who, will manage that liquidity for you for some fee. So it's becoming more complex now because of these, concentrated liquidity mechanisms. But what Fluid is doing is they're kind of managing it for you and creating new primitives, right? So the smart debt and smart collateral patterns that they have allow you to deposit, a single asset. Let's say, in my case, it'd be like wrap Bitcoin or something like that. And it'll be pegged against CB, BTC, Coinbase's Bitcoin, right? So pretty close in terms of pricing. They should be approximately 1-to-1. So the impermanent loss risk there is then eliminated. I'm now getting trading fees for people doing CB, BTC to wrap Bitcoin swaps. And then I can use that collateral and I can borrow against it as well. And not only that, it's also kind of almost Alchemix-like in that the trading fees are also being put towards that collateral as well, right? So given enough time, that debt eventually sort of pays itself. These are all like really, really cool mechanisms, DeFi primitives that we've seen previously kind of combined into one neat package now with Fluid. And we're seeing other implementations as well. I'm sure you guys have heard of Euler Swap, which is doing something very similar. And one thing I like about Euler Swap is that they've maintained, so this from the builder's perspective, they maintain the same interface as Uniswap has. So if I want to build on Euler Swap, and I've already built on Uniswap, it's easy for me. I can just use the exact same code. Every single pattern and mechanism is the exact same. And they actually behave like a hook. So we've seen other hooks before, Bunny, F-Launch, and others. And hooks are really powerful because they allow you to do things with your liquidity before you deposit. So wrap them into interest-bearing stables before depositing into the pool and that sort of thing. So hooks open up a lot of venues and mechanisms for managing LPs and making it easier. So this has recently been introduced with Uniswap V4, of course. Uniswap V3 didn't have this feature. And, it allows builders like Bunny and stuff like that to basically turn complex LP position, like a Uniswap 4 position, into something like a UniV2 position. And that helps with composability, right? Because I'm sure you've seen a huge drop off in farming because, you used to deposit full range LPs and then just chuck those into some vault. That's a lot harder to implement now with CLPs and ranges. But, hooks like Bunny, you can do that now, right? So becoming an LP is complex, but it's over time becoming more and more easier with innovations like Fluid kind of leading the way and that side of things. I use Fluid myself. I have deposits in there right now. I'm taking advantage of the trading fee and levering up my Bitcoin, and I think it's a great mechanism. I think it's one of the reasons we're seeing so much swap volume there as well, right? Is because it's attracted so many users, and all of these depth aggregators, they just look for the best possible rate, and often those are the ones with the most depth, right, and liquidity. And we've seen them pull this off with no incentives, right? They haven't been like, hey, we're gonna airdrop Fluid tokens to the biggest depositors, and to some extent they have, but we've seen this much more extensively, right? Even Uniswap did this during the vampire attack from SushiSwap. That's when they released their token to try to get that liquidity back. We're seeing now with Fluid that just building a good product, excellent mechanisms, allowing users to get in easily the UX side of things. That's the driving force now. That's where the real yield is coming from. And I think more and more teams are going to start emulating, what Fluid is doing.
Yeah, I think the fascinating thing about Fluid is the point about there being no incentives. Like basically everything in DeFi has always had some sort of incentive behind it. There tends to be a token reward associated with nearly every protocol. It's caught us off guard too. Like I keep reminding myself as they've risen in the rankings. I think they're, as of today, 4th among all DEXs in terms of, I'm just looking at 24-hour volume, and that's putting them just behind Uniswap, PancakeSwap, and it looks like Radium is the other one. Actually, speaking of Radium, speaking of Solana, do you find any DeFi in Solana interesting? It's one of I think the big chains here that we haven't covered so far.
Yeah, so for Solana DeFi, so I know Fluid's launching on Solana, obviously, so that's going to be a big boon for them in DeFi. But from my perspective, it's a lot harder to do my style of investing, which is I want to audit the contracts and that sort of thing. That's much harder to do with programs on Solana. The Explorer, in my opinion, is not as good. So these are kind of like the things that really affect it. Also, the dev tooling. I think for Solana, we're still like where Ethereum was back in 2020. Like we're still using the equivalent of like Truffle and like consensus-made tools in Solana. We don't yet have like the paradigm tools, right? Like the the VM and these high value dev tools that are really needed to really create complex composed smart contract interactions like we can on the EVM side of things. Obviously, they're doing a ton of work on that side. They're attracting more and more builders. Things will get better, but I'm not really doing a ton on that side of things other than through, like we discussed earlier, managed vaults, right? Where I can actually deposit it in an EVM chain and then they'll take that over to Solana and play with it on Jupyter or whatever. So that's how I get my exposure on that side of things. But I'm pretty much an EVM maxi still. That's mostly because I've been building in the space for so long, and the dev tooling is just next level for the space I'm building in particular.
Hey folks, I want to tell you about our sponsor GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to GEARBOX.fi. RUMPEL Labs is revolutionizing DeFi. RUMPEL lets you turn points into profits by tokenizing rewards you can trade from top protocols like Pendle, Athena, Fluid, Symbiotic, and many others. No more waiting for airdrops or TGEs. DeFi's smartest investors are already using RUMPEL to unlock instant liquidity and maximize their yields. So join RUMPEL today and start spinning your points into gold. Learn more at rumpel.xyz. Say hello to Puffer UNIFI. Puffer Finance is expanding beyond native liquid restaking with new products such as UNIFI-based ROLLUP and UNIFI Pre-Confirmations AVS. UNIFI is not just another L2. UNIFI is a based rollup, one that will solve L2 issues, such as slow withdrawals versus instant withdrawals with Puffer UNIFI. Puffer UNIFI is fast, capable of sub-second transactions. UNIFI also has boosted Puffer points, which means if you bridge assets, you earn boosted Puffer points and rewards from dApps on UNIFI. Puffer's core products mean a bright future for Ethereum. Learn more at Puffer.fi.
Suhail, would love to get your take then on HyperEVM. I don't know if that's something that you're paying attention to, but for me, just looking at kind of the composability between HyperCore, the amazing trading app that they've built, and the HyperEVM, it seems like a new DeFi innovation where, I think that's hard to rebuild, or it's almost like a bit of a moat to just this. I think Core Writer just launched, and now there is that like composability of information across, HyperCore to HyperEVM. So I guess from like somebody looking through it from the Portals lens, is that a chain that you're like actively looking to start supporting or getting involved with?
Yeah, for sure. I mean, and it comes back again to the vaults, right? The vaults were a big part of, their success. It allows anyone to deposit liquidity there. It attracts liquidity for them, allows people to leverage using that liquidity. And of course, it's EVM based, which I love. And interestingly, the TPS isn't even that much, right? It's like we're looking to do like 10,000 TPS on Ethereum. I think they're like, like 12 or something like that, or something really low. I don't recall the exact number.
Yeah, it started very low. It's like a staged process of ramping that up over time. But yeah, totally. It's low as it stands today, for sure.
Yeah. And yeah, the good thing about it is it's EVM, and we're starting to see more and more actual DeFi apps deploy there, treating it just like any other EVM, even though the main venue is obviously, leverage trading and perps and stuff like that. But because it's EVM compatible, and this kind of harkens back to the Solana chat, if I build something for Optimism or Arbitrum, I can deploy it on HyperEVM as well, and start taking advantage of all the liquidity that's found its way over there. So if I'm a protocol, I'm definitely going to be deploying there. And if protocols are deploying there, that means that Portals has to deploy there as well. Because we want to be able to take advantage of all of the yield that's available on that chain as well. And it doesn't necessarily imply that you have to be a degen and leveraging up, right? There's a lot of DeFi happening there that's not just leverage trades and stuff like that, which is interesting to me to see, because we've seen with like DYDX who've kind of gone with this approach, launching their own chain. We're not seeing any of that happening there, and that's part of the complexity of their chain, right? It's not is easy to build on as something like an EVM on Hyperliquid.
I think that we should talk the last few minutes about Portals, because I think for all the opportunities we're calling out, like you need that as your gateway. I just have one last question in terms of trends. Like one thing that I'm starting to wonder about is I thought that we would just build better applications, better wallets, and it would lead more users to interact on chain. Like maybe they're working with like a Web 2 looking app, but they're ultimately transacting on chain, and they're getting the best yields, they're getting the best opportunities. But now with all of these treasury companies launching, like we've got SharpLink, SBET, we've got BitMine, which I think BitMine doesn't even hold Ether yet, but it's been really popular because of the chairman, Tom Lee. There's multiple other treasury companies. There is a Hyperliquid one that we just had on recently. There's a Hype treasury company called Hyperion. There are multiple Solana treasury companies. So I'm starting to question, like, is there that much more capital, aside from all the stable coins that are going to come on chain? Is there that much more capital that's going to come through these like goofy vehicles where they're listed on a stock exchange, people are buying the stock, but then the money is ultimately under the hood being moved on chain and buying ETH and Sol and Hype and Bitcoin as well, and then they're staking it. In the world of ETH treasury stocks, you can do that. Sol as well, Hype as well. Is this like not the outcome we expected? I'm curious, like, what are your thoughts, like as like a longtime builder?
Yeah, not so much the outcome we expected, but I guess we should have planned for, because I mean, think about the complexity of just getting on chain, right? Like think about seed management alone, right? That's a huge challenge for a normie, for a retail user. If you're an executive at some company, you're working your day job, you don't really have time to manage this stuff. You already have probably some trading accounts, you probably have a Roth IRA or something like that. And you're using the same companies to, have exposure into Bitcoin because, Larry Fink is saying Bitcoin's the next big thing. You don't want to mess around with on-chain stuff. So you just, buy through traditional finance mechanisms. But as long as that capital ends up on-chain, it's good, right? Because that means that, either they're buying that ETH from, OTC desks, maybe even on-chain if we get there, if there's enough liquidity for them to, feel comfortable doing so without price impact and slippage and that sort of thing. But we are seeing President Trump, for example, his team using CowSwap, on-chain swaps, right? So I think, we will start seeing more and more, of these types of sophisticated users coming on-chain because they just want more control about where their assets are being deployed. And maybe they don't want to hold ETH, right? Maybe they want to hold an LSD instead, or maybe they want to lever up that LSD slightly. I'm skeptical that these companies are all going to be able to do this to the same efficiency as we can on-chain. Just because that's where, most of this stuff is happening, right? That's where the LSDs are deployed. That's where the protocols are building looping strategies and that sort of thing. So it's both good and bad in that we can get that liquidity on chain, but it's bad in that, it's very much turning decentralized finance into centralized finance. And it kind of goes against the ethos of, trustlessness, decentralization, all of the things that are builders like myself, hold near and dear to our heart. But at the end of the day, that's the evolution of crypto, of DeFi, right? It's going to be, in the future, I think, it's just going to be called fintech. Folks are going to be using on-chain apps without knowing they're on-chain. This is the very, very early stages of that, I think, what we're seeing now.
We did a number of other episodes recently with institutional type investors interested in DeFi, or in the case of Upshift. Upshift is a platform for vaults that are ultimately these strategies being run clearly for bigger money to scale into. And I think the takeaway from all these conversations was that even the big guys that with the biggest amounts of money, they just want the simplest access to yield on chain. They don't want to have to your point, they don't want to have to manage wallets and keys and seed phrases and worry about this. And, in the case of Upshift or Portals, you do have to have the savvy to have an EVM wallet, but they are still just looking for one click. They do not want to worry about MEV and swaps and multiple steps to get into, the best yields. And I guess they want a reliable network, which is why Ethereum continues to, hold the lion's share of all liquidity.
Yeah. And we're also seeing, things like, Stripe acquiring Privy, right, which is big. Wallet management company being acquired by someone like Stripe implies that they're going to be pushing this out to their users as well, who are, largely not crypto users, I would say. So we're seeing it happen, right? So for those folks that don't want to manage their keys or whatever, they can use passkeys instead. And that gets them on chain in a much less, with much less friction.
Suhail, we've been referencing Portals sort of this whole discussion, but how do you like to describe Portals to people that are just learning about it, or how do you kind of articulate it to people?
Yeah, so I like to describe Portals as a DeFi aggregator. So what we do at Portals is we try to aggregate all of these different positions that we've talked about, right? So beta vaults, Upshift vaults, Uniswap LPs, Pendle positions, PTs, YTs, that sort of thing. And what we want to do is we want to normalize everything, right? So if you compare an APY on Morpho and an APY on Beefy, for example, some of them will use token incentives in their calculations. Some of them won't. Some of them will have optimistic estimates, that sort of thing. So the idea with Portals is we, first of all, want to normalize everything so you can compare everything directly. Am I actually better off being in this Morpho vault at 12% versus Fluid vault at 14%, for example? It depends, right, on the base APY, on the reward APYs and that sort of thing. So that's what we want to present to users. They shouldn't have to go to 7, 8, 9 different dApps, do all the conversions themselves, figure out how to get into those positions and that sort of thing. So the idea with Portals is we show you all of the context you need, right? So APYs, TVLs, holders, all of the deltas and all of those different aspects. And then ultimately you decide if you want to get into or out of those positions, and it's all in one click. So like I alluded to at the very beginning, we like to think of ourselves as a buy now button on Amazon. You see something you like, you click the button, it shows up in your wallet. You're not concerned about several apps, different chains, different approvals, bridging, all of this stuff. And it lets you do cool things, right? So you can earn yield on Base on a Morpho Vault and then repay a loan on Aave on Ethereum, for example, all in one click. So it's all about making DeFi accessible, easy to use, trying to break down the barriers, and just have all the context you need to make an informed decision ultimately. And it really allows you to employ my strategy, which is to look at what the risk curators are doing and then just go do it yourself. Because it's, for me, on Portals, it's just one click. So.
Yeah, I really like the Amazon analogy too, where you said then you don't have to worry about the size of the truck, how much freight it can carry, how expensive the gas is. I think that kind of really encapsulates it nicely. And it was actually, so it was DeFi Dad who put Portals on my radar. And then I started using it because I like to buy Pendle YTs. I don't think that's a secret. But I think just that the visual data display that Portals shows, even versus the Pendle UI, is like amazing. So I got one question. So there's obviously a user front end play here, but when I go to Portal's site, the data and just the visualization of it and the UI UX of it is, I think, amazing. So is there ultimately a bigger data play here too, where you're going to monetize that side of Portals as well?
Yeah, so Portals actually started out as an API company. So everything on the app is built on top of our own API. And, we have around 1,300 builders using the API under the hood. So, folks like Contango, if you've ever done a loop on there, you probably used this under the hood. Barter Swap, one of the big cow swap solvers, if you've executed swaps there, you've probably used us. Vaults like Harvest Finance, Yearn Finance, and stuff like that uses under the hood, again, for the one-click interactions. So we launched the Portals Explorer about a month and a half ago. We've tagged it as an alpha, so it's still a very, very early version. There's still a lot of work to be done on it, but we wanted to launch it to basically get some feedback, that sort of thing, make sure that, we were kind of on the right track there. And from here, it's going to be expanding out quite significantly. Portfolio features and that sort of thing. You'll be able to track your PNL, your ROI, lots of cool features in the pipeline for sure.
So Suhail, you've alluded to some new features coming, but just kind of curious about the longer term vision maybe with Portals and what the roadmap looks like. Is there sort of a North Star or end goal where you ultimately see Portals heading towards?
Yeah, so Portals, we designed Portals to be a DeFi aggregator. And one thing that we're really proud of is that we now are able to get brand new tokens on chain the second they're deployed. So before CoinGecko, CoinMarketCap, DeFi Llama has it, Portals is going to have it immediately, and it's going to be executable. So you can zap into that position immediately. So if Morpho launches a new vault and they don't even announce it, you're going to have that alpha if you use Portals, because you're going to be able to see that they deployed a new vault. It's got $12 in TVL. Right. So you can keep your eye on that. So one part of it is the alpha side of things that we're really trying to push. But you've used the app. You've probably seen that it's basically just, a single page right now showing charts and tables and that sort of thing. What we're going to be doing is zooming out from there. So we're going to be showing kind of a homepage which shows, benchmark rates. So one thing I like to do is I like to compare benchmark rates versus the yield positions, right? So if I can already get 6% on Aave, is it worth doing, a more complex strategy to get 6.5%, right? So that's one thing we're going to be showing folks is all of the benchmark rates, trending PTs and YTs at the very top and that sort of thing. So you're kind of aware of the alpha, where the liquidity is moving into. And then below that, we're planning to show on the homepage all of the trending opportunities, right? So all of the ones with the most recent net inflows. So you can see where liquidity is moving on chain in real time. So we're also planning, my history is Zapper. It's a portfolio company. We're planning to launch a portfolio view as well, so you can keep track of all that stuff. It's going to include stuff like P&L, ROI, all the stuff that your accountant wants when you enter these complex positions. So who executed it, what time it was executed, what's the effective rate, all of that stuff is going to be available on Portals for complex things, right? So Pendle PTs, YTs, LPs, faults, that sort of thing. I think that's a segment that's, underserved in DeFi. And then beyond that, of course, things like watch lists. So obviously, we aggregate a lot of positions right now. So just over 20 million discrete tokenized positions are available on Portals. That's more than DeFi Llama and CoinGecko combined in terms of USD priced tokens. And all of those are executable. So that's a lot to parse and go through, right? So with watchlist features and that sort of thing, you can add favorites, monitor, inflows, outflows. We're also going to be introducing, and this also harkens back to our security and that sort of thing is stablecoin depeg detection, right? So if you choose to, you can see which stablecoins are depegging and that sort of thing, because these are also, like they said in Game of Thrones, chaos, is a ladder too, right? You can take advantage of these depegs and actually do quite well with them as well. So we're trying to surface as much DeFi context as we possibly can. We're going to be turning Portals into a super app. So it's the first place you go to look for yield. It's the place you go to zap in to manage your positions and that sort of thing. And the key thing that we have to do there is to make sure we aggregate basically everything, right? So 99% isn't enough because degens are always after the newest opportunities that are launching on chain. If you add an opportunity 2 weeks later, you're probably too late to the game for a lot of degens. So that's one aspect that we're going to be focusing on a lot is surfacing brand new opportunities as quickly as possible as well.
Just so many cool things in development there. And, I know our listeners will be excited to learn more about that. So I think this is a good place for us to wrap up. And so I want to remind listeners they can learn more about Portals.fi by going to Portals.fi. They should follow Portals_fi on X. Follow Suhail's personal account. It's Cryptonomic on X. Otherwise, thanks for joining us, Suhail. Really fun to, get your perspective on all the different DeFi yields out there. I know there's been a number of questions I had about just some of the trends, and frankly, as much as we talk about it, I feel like my my blind spot, of course, is being an actual engineer and having the lens of looking at it at the smart contract level, or just thinking about the way that these protocols are architected. So I hope that people are able to take away, some sense of, what is working and what maybe isn't working as well as they thought it was in DeFi. But main thing is, for all of the risk that we talked about and for all of the benefits of all this new DeFi, you can abstract away some of that risk by just using Portals.fi. So I hope folks will take the time to check out the platform. But any final word for us before we go?
Yeah, DeFi is all about composability. I think, we're starting to see more and more of that popping up, and I'm excited for it. I'm looking forward to seeing, even more complex positions that we can add to Portals to make it easier. And thanks a lot for having me on. It was a pleasure to talk to you both. Thanks again very much.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.